and what I'm going to do now is just talk a little bit about support and resistance, and we'll talk a little bit about the charting session. So just going back to Google, this is our chart. Now remember, let's start marking up. So really the charts are giving you price. This is a basic price chart. So what, just as a recap from yesterday, what are the three pieces of information we get from the exchange that can help us with our trading? What are the three critical bits of information we get? Perfect, Dave. Excellent, good stuff. So price, volume, and size. So they're the three bits of information we get. And where does that come from? That's our time and sales window, isn't it? So on TradeStation, if you want to see that, you go into your time and sales window, and that will give you that information. So price, volume, and size. Now, what are we seeing on this chart at the moment? What information are we getting on this chart at the moment? Out of those three, so price, volume, size, what are we actually getting? What information is coming into our chart? Price. So what's our advantage in with our edge in relation to this chart and trading this market? If we've got 1 out of 3, we're basically not in a fantastic position, are we? We've only got 1 out of 3 of our, so that's us. If we've got no indicators on here, that's basically all we're getting. We're getting price information. So does price, if our information is based on price, then if we go to our indicators, because this is just pure price, isn't it? These charts are made up of these are bar charts. So we'll put that up there. They're a bar chart, and they've got an open, high, low, and a close. So if we've got one of the three things that we could potentially have to make decisions, are we at a slight disadvantage there in relation to the information we're getting through on our charts? If we were trading off this chart, we're only getting price. We're definitely at a disadvantage, aren't we? Because we've got no idea about what's happening with the volume. We have volume on the volume up here, but that doesn't tell us. That's basically the transaction volume. So it doesn't tell us at all what's happening with the buyers and the sellers, does it? It doesn't break the information down. It just says that's the total volume. So what we want to know is we want to know what's happening with the buyers and the sellers, because that's the information we need to base our decisions on. So at the moment, all we've got is the open, high, low, close. We've got the total volume. That's the total number of transactions that went through, but it doesn't tell us who had the upper hand, the buyers or the sellers. The price does, but the volume doesn't. Now, if we've got a bar chart and we're looking at that, and we've got an open, high, low, close, that can obviously give us some good information. Now, with these indicators that we've got on our chart, with the indicators, what do you think, what percentage of these indicators here when I go into TradeStation, because they're all indicators, what percentage of those are volume indicators? Sorry, I apologise, are price indicators. What percentage do you think of those indicators will tell you what price is doing? So of all the indicators that we have on our on TradeStation, what do you think, just as a bit of a guess, we'll all guess this, what do you think the ratio is for these three things, these three critical things that we want to know price, volume and size. So price is 70%. Yeah, it's probably a bit higher. Almost every indicator on TradeStation would hazard to say to be almost 80 is based on price. So if we're just looking at indicators on price, then the only thing that really is giving us the um, actual kind of candle or price bar by price bar look at what's happening with price is the price bar. All the indicators are really lagging indicators. That means they're calculating formulas to basically predict where price will go. So we use our indicators when we're looking to add. We use our indicators to predict where price is going to go with a certain percentage of certainty. Now, if 80% of the indicators are price based, we miss out on the volume and the size indicator. So that's not a good thing if you're trying to get a complete package of the market. So the indicators really, when we're trading, we want information that's going to tell us or potentially give us an idea with some statistical validity where price is going to go, because price is the one true thing that will that's happening on, well, it's price, volume and size, but we're looking to find out where price is going to head next. That's our goal as a trader. We need to identify where price is potentially going to go. We're not trying to predict it, but we're trying to find out if our system, which is made up of a group of indicators, so our system here is made up of a series of indicators, and that all that is doing is predicting movement, isn't it? It's not really doing anything else. It's predicting movement based on these three things: price, volume and size. Would adding additional indicators improve our system, or could it potentially not improve our system? So if you think that basically your system is made up of indicators, does adding more indicators make your system, or give your system, a higher probability of predicting where price is going to move? Really, the system is not the key to making money, as we know. The key to making money in trading is being able to take advantage of when price moves. So the system could potentially be worth, you might rely on, say, 15 or 20% of the system to tell you when to get in or out of into the trades. But what you're relying on is you're relying on your money management. So your money management, because that's what's going to either make you long-term successful or not. The system is really only adding 15 to 20% to your overall model. What we need to do is remember that money management and psychology are the things that are going to, trade psychology and the way you position size, like we've done with the money management program, that's the way in which we leverage off being right in the market, because we know that regardless of what happens, most systems will generally, if they're a high win rate system, they'll do well for a short period of time, and then they'll typically fall over, or they will, if they go through a negative losing run, they usually have a skewed reward to risk. So that means that they're risking far too much than they're collecting as far as their reward. Whereas on the other kind of end of the spectrum, you've got the lower performing strategies, like the 40-50%, that typically have a much higher reward to risk, and they're the ones that we're trading. So our indicators really are just looking. They're giving you lagging information on price action, And what we want to do is we want to try to make sure that we're not really trying to. Our goal is to predict the market, but we're not basically trying to make our system all about being right all the time or predicting the exact move of the market. That's not how we trade. All we're doing is we're trying to identify where there's higher probability setups, turning points, or directional plays in the market. So predicting is not a great word, but what is a good word is directional movement of the market. So our system gives us the directional movement of the market up or down with a certain level of a win rate or a certain level of accuracy, and that accuracy, it may be above or below 50%, but that's really irrelevant. What's relevant to us is once we're in the market, how we actually trade that strategy, how much risk we take, how we compound our profitability or our profitable trades, and how we protect when the market isn't giving us what we want, and how we identify when there's not a lot of movement in the market. Because the other thing too is that when we're trading, we need to make sure that we've got good movement to make money. So if we look at our system and our indicators, the indicators we could put 10 indicators on this chart, and they would at one point or another they would probably line up, but that doesn't guarantee us any more success with our accuracy. Really, the only way to improve your accuracy in the market is to have information specific to price, volume and size. That's the only way to improve that accuracy in the market. So those three things, and we're not really trying to be as accurate as we possibly can. We're trying to be smart about the way we use our time in the market and our money management, and to get the most juice out of the trades that we're trading. So having an idea of market structure and market movement, and having a good idea or an excellent knowledge and skill about money management, position sizing, and when to add and when not to add to positions. So all of that information helps us to build our account. Now, as we said before, if the indicators are there was an interesting exercise done by Tom Bazzo, who runs a fairly significant hedge fund. He just took a random entry on the futures market, so did not have an indicator telling him when to get in or out. He just basically took a random entry on a futures market. I've forgotten what commodity it was, and then he used a fairly significant stop. I think it was 2 times the average range, and what he did was he trailed that. He basically trailed, or as price moved in his direction, he moved down according to the movement of price. And what he found was that actual methodology produced fairly significant profit, but it's probably something that most people would struggle to trade with because of the size of the stop. Now, that's just showing you that just random entry, because he had no indicator to get in the market. What he was using to make his money and to show that he was able to be successful was the application of money management. So he knew that once he had started to get some winning trades, he was position sizing up like we do with a fixed ratio, and he was also using the volatility or the volatility of the market to stay out of the noise. So there's 2 critical things there. Number one is that strategy doesn't work for it. Obviously, won't work for a lot of people because number one, the stops are very big, and number two, you've got to be prepared to take a lot of heat on your trades and not have not have really much concern about any trade you get into, because if you've got a fairly significant stop, you've got a very low win rate, which that strategy did, then you've got to have really accepted the methodology and the level of risk you're taking, but it was still profitable. And that's why when we develop strategies and look at systems, we tried to get our win rate at a level where we know traders will be able to comfortably trade it, and not necessarily comfortably, but trade it with a reasonable expectation about reward versus risk, and also